Hi, my name's Doug. I'm with Weichert Realtors, the Griffin company, here with Gary O'Connor of Fairway Mortgage. Thank you for being here, Gary. And we're going to go through some questions that buyers may have for their mortgage lender. So, Gary, hope you're ready. Got some questions for you.
Let me introduce myself.
Yes.
Just for a few minutes. My name is Gary O'Connor, and I'm with Fairway Mortgage. I've got 40 years of mortgage lending experience. I've been here in the Fort Smith area for 20 of those years, and I'm honored to work for a company called Fairway Mortgage. We're the third largest volume mortgage lender in the country, and we are honored to have offices here. We got about 400 or 500 offices nationwide. Here to help you with any answers to questions.
Awesome. Thank you. Okay, we'll get into it. First question. How much should a buyer have saved? Now, I say that as dollars and percent. If you have $10,000 saved and you're buying a $100,000 house, sounds pretty good. But if you're buying a $450,000 house and you have $10,000, maybe not as good. So tell me, in dollars and percentages, what do you think they should have saved?
Well, a lot of people come to me and they just don't have any savings. Their bank account is month to month, and in fact, I think that so much of the world works exactly like that, just living from paycheck to paycheck. That does not always stop your ability to buy a home. So many of my clients are getting no down payment loans. The USDA Rural Development Program, the VA program, no down payment requirements. FHA, minimum down payments, 3.5%. So for a $100,000 house, you're looking at about $3,500. For a $400,000 house, you're looking at $14,000. So down payment is helpful. On Fannie Mae and Freddie Mac loans, first time home buyers, 3%. Buying your second house or any other type of property, 5% down payment.
Okay, got it. That kind of goes into my next question. Assistance programs. If someone doesn't have a lot of money, what kind of programs are there for first-time home buyers or maybe not first-time home buyers that are available?
Well, the first thing you got to know is that you do have to qualify for them. They're just not free money. So most of those are designed for lower income families. So if you make less than the average income nationwide or average for our area, some down payment assistance can be available. Some of them in the form of grants where it's free money. You're buying the house, you get the down payment as long as you qualify. Some programs where they actually give you money but put it in the form of a second mortgage. So you do have to pay it back over a period of time. And then there's some hybrids that are something between. Some grants, down payment, but basically all with the goal of getting in a house, minimizing your out-of-pocket.
Okay. Next question. As far as credit is concerned, now this is two parts. What kind of impact will it have if you run my credit to check to see where I'm at? And then secondly, what should my credit score be if I'm actually thinking about making a purchase of a new home or just a home in general?
So credit score adjustment. So when a borrower calls us, a prospective buyer wants to get financing on a house, the first thing we got to do is look at that credit. We have to make sure that the credit's going to be up to the standards that the mortgage lenders want to see. In order to look at credit, there is an inquiry to your credit report. If we do a hard pull, that is going to be on the TransUnion Experian Equifax as a hard pull and can affect credit scores. Fortunately, FICO is Fair Isaac Credit Organization, has been designed for the mortgage industry. And those versions of the credit report, if I pull credits where it's a mortgage pull, you can apply to multiple lenders and supposedly not have your FICO score change. But there are other scoring systems. Those for automobile loans are not FICO, not the same versions. There are credit cards and other scoring systems. Those can be affected. So the way that we handle those is we do what's called a soft pull. With a soft pull, there is no hard inquiry. It's very informal. But we do get to see what's taking place on your credit, and we do get your FICO score, and it does allow us to do a consultation on how to improve your score if we need to. But with the soft pull, we shouldn't have any effect to your scores.
Okay. Good.
But the second part of your question is, what should your score be?
Mm-hmm.
Well, that's another great question. And typically, we'd like to see scores at 620 or better. National average is around 700. So anything above 700, typically we're going to be talking about a conventional loan, because those tend to be a little bit more attractive, because less expensive on mortgage insurance. Interest rates are a little bit higher, but it drops off after a period of time, the mortgage insurance after a certain period of time. But government loans have become more attractive on mortgage insurance. FHA has dropped their mortgage insurance rate down to about 0.5, and the interest rate tends to be a little bit better. But if you're in the 580s or the 550s, if you are below what a lender wants to see, most of us will help you with a consultation on what steps to take to get to where you need to be. So no matter where you stand, if you have a desire to buy a house this year, now's the time to get started. Let's take a look at our credit. Maybe there's some things we can do to make adjustments and to bring that up. And even if your score is still good enough to get a house loan, if there's some things we can do to help improve it a little bit better, we're going to make that recommendation, because the better your score, the better your rate. And it opens up more loan programs, more options that are going to be best for you.
Okay. Okay. Good. Next question. You touched on it for just a sec there. Mortgage insurance. How much is that? What can I expect? Just tell me about mortgage insurance.
Mortgage lenders have a wide variety of programs to offer their clients. The government programs are typically FHA loans, very popular, especially here in Fort Smith. VA for those veterans, we love the veterans. And USDA for people buying rural properties for no down payment programs. Each of these have different mortgage insurance mortgage insurance rates. FHA is about 0.5, it's 0.55. Rural development's about 0.35, and VA is gone. There's no mortgage insurance rates on VA, which is one of the reasons why we love VA loans.
Nice.
Each of them have an upfront fee that's added to the purchase price, added to the loan amount, but government loans are not as bad as they used to be when they were much more expensive on mortgage insurance. There is something called private mortgage insurance, which are insurance companies that will help insure a conventional loan. Now let me make sure that I have it clear. When you want to put less than 20% down payment on a house, mortgage lenders want to be protected by that mortgage insurance being provided by somebody else. That way, we're more interested in giving a loan, and your interest rate's going to be better.
Got it.
So that's why mortgage insurance is important. We do love it when you want to put 20% down payment, and we're continuing to look for more clients to do just that.
Perfect. Okay, next question. Closing costs. I know that's a big part of home financing for a new buyer. What should a buyer anticipate paying in finance closing costs?
Well, that's a challenging question, because everybody's going to be a little bit different.
Okay.
Let's make up what those closing costs are.
Okay.
So closing costs are made up of lender's fees, title fees. Those are the people that are transferring the ownership from the seller to you. There's transfer taxes involved. The state has to get some money for that. A big part of the closing costs are the insurance rate. You have to pay a full year of insurance on the day of the closing. There's escrows involved, there's processing fees involved, and so most settlement statements have anywhere from 20 to 30 different fees, all breaking out in different directions. Your lender should be able to help you with deciphering what those fees are, explaining those. But for a $100,000 house, I would expect the closing cost to be between maybe $4,500 to $5,500 typically.
Mm-hmm.
For a $200,000 house, maybe $7,000 to $8,000. These can change with buy down of interest rates. So you can pay more money to get that interest rate reduced because there's a cost of money. And lenders sometimes want to play that game, especially as rates are a little bit higher than people are comfortable with. So all those can play a factor in the closing costs. The best part of closing costs is that by the government loans, they allow up to 6% of the purchase price to be paid by the seller, reducing the buyer's need to be able to pay those costs. So it's part of the negotiation when you make an offer on a house. And another reason why we definitely want to get pre-qualified with a lender so we know what the costs are going to be long before we make that offer on a home.
Perfect. Okay, that's a great answer. Next question. I know you don't have a crystal ball, but I know you've got quite a bit of experience. So where are interest rates today and where do you see them in 2025?
Well, that is one of my least favorite questions and also one of my favorite questions. So let's talk about that. I got in the business back in the 80s, early 80s, and the rates were up above 15% at the time. I don't know why I got in the mortgage business then, but I did. Over the next several years, until about 1986, the rates came down to 7%, 8%. Refinances of all those 15% interest rates were across the board for the next several years. Every lender was busy in 1987. Slowly, over the last 30 years after the 80s, the interest rates settled down to the low sixes to the high sixes, teetering into the low sevens, sometimes into the high fives, but for the most part, mid sixes seem to be the average throughout the last 30 years. 2008, 2009, we call it the mortgage crisis, but it was really the economy that was in challenge. We had a big problem with unemployment. We had a problem with people losing houses. At one point in time, Doug, in 2009, 2010, there was about 20% of the homes on the market were all foreclosed houses. Mm-hmm. To get the economy back in order, they reduced the interest rates so that we could get people to buy those homes. Mm-hmm. The rates tumbled. The Federal Reserve purchased bonds artificially, lowering those interest rates. And slowly but surely, from 2010 until about 2022, those rates dropped from the sixes down to the threes, and sometimes even into the twos. So there's an awful lot of people who have very low interest rates on their homes mm-hmm. for the last 10 years of purchasing. We all know about inflation. We all felt it in the pocket. And when inflation hit us, we needed to do something to slow down the economy. They, again, artificially raised the interest rates so that we would slow the economy down. We're stuck now with a little higher rates. So here we are today. In the last, I would say 12 months ago, we were in the sevens, clearly into the sevens. But in the last year, we've seen them come down into the sixes. So I see today low sixes to high sixes for the most part, pretty much where we were for the last 30 years. Unless something significantly changes in the form of inflation in the United States, in my opinion, we're going to remain where we are today. Mm. So if you like the rate, if you like the payment, don't buy a house assuming that the payment's going to be lower with a refinance to rates that were some time ago. Mm-hmm. Because getting back into the threes and the fours, I don't think they're going to be there for quite a long time. Mm.
Got it.
So where we're going to be, I think we are where we're going to be.
Got it. Okay. Okay. Good answer. Next question. Pre-approval. Now, I tell my clients the first step to buying a home is talking to your lender and finding out where you stand. So tell me about pre-approval and what that looks like.
First thing that every real estate agent should ask their client is, have you been pre-qualified? Mm-hmm. And talk to a lender. There are several reasons for doing so. Not just am I qualified to buy a house, but to get an idea of how much house I should be shopping for. Because often there's a disconnection between how much of a house will satisfy my family needs mm-hmm. and how much of a house payment is in with my budget. So talking about price ranges, talking about how much of a house you can buy at the comfort zone that you have with your budget, with your family, that's a very important process. We don't want to be shopping for a house that exceeds our comfort zone on a house payment. So getting that figured out is also extremely important at the beginning. But we can determine in 15 to 20 minutes who you work for, how much money you make, how much you have in the bank. Take a look at your credit, see the scores, who you owe money to. That's really just about 90% of do I qualify? Let's set up a program. I want to do an FHA, I want to do rural development. Where do you want to buy? Are you a veteran? All those things can be figured out so that at the end of that 30-minute, we know what direction we should be taking. And when you do find a house, I can provide a letter of pre-qualification. They got the credit, they got the income, they got the money. We're in good shape.
Okay.
That's different from a pre-approval. A pre-approval is when I've looked at the buyer's paycheck stubs, their W-2s, their bank statements. I've seen everything about them that's going to be a factor on the decision making. In that case, I can give you a pre-approval because I now have seen what they need. But it is an important process and should be done before we look at our first house.
Got it. Thank you for making that distinction. Next question. How long does a pre-approval last? If I get one today and then I don't shop for homes for 5 or 6 months, is it still good? How long does it last?
Well, I'm going to give you an answer that most lenders would not give you.
Okay.
So most lenders would like to say it's good for 60 days or 90 days because that's how long the credit's good for. We can do a credit report today that would be good for 120 days. Buy a house, we can close with that. The challenge with that is that I don't want anybody to be under pressure to buy a house in a limited period of time. This is the most important financial transaction of our lives. Let's make sure we make the right decision making.
Sure.
So the reality is that pre-approval or pre-qualifying is really only good for maybe 24 hours. And it also might be good for years. The difference is because the guidelines really don't change, not very often. They do a little bit, but it's only about the documentation requirements that are necessary more so than the qualifying of the client. So the pre-qualification is important, but if you go down the day after I qualify you and file bankruptcy, I probably won't be able to have you buy a house. If you go out and buy a very expensive car and incur a new debt that's going to be much more on your budget, that could change your qualification. You may not qualify to buy a house and that car at the same time. If you change jobs, if you no longer have the money in the bank that you told me you had, a wide variety of factors. In other words, as long as you remain financially stable, you should be able to buy a house anytime that you want to buy a house. And if you want to make any adjustments to your financial picture, pick up the phone, call your lender, tell them about it. I'm going to buy a car, I'm going to buy a boat. That RV that I've had my eyes on, I'm going to buy it before I buy a house. That could adjust our ability.
Perfect, yeah. Got it. Very good. And that leads us into my last question. What advice or warnings, or both, do you have for someone who's just decided, I want to purchase a house? What would you tell him?
Great question. So let's suppose we decide that this is our year. This year we're going to be homeowners. The first thing I would say is let's monitor our credit. If the lender has some ideas on steps you can take to improve your credit score, know that you're going to see a better interest rate with a little better score. So let's make some adjustments if you can.
Okay.
Second thing is, let's go on a financial diet. If this is our year, perhaps we can pull back on those things that have been things that we spend money on that we could forego. I'm not saying don't take a vacation, take a cheaper vacation. Let's be careful with the spending of money because the more that we have, the more that we can have for our new house. If you can save an extra $1,000 by not buying something today, you might be able to put window coverings in. You might be able to get some more furniture. You might have moving expenses. You might have utility bills. Other things would be important. The more you have, the better you're going to be off. So saving some money is a very good idea. Credit monitoring, saving some money, just be careful with your finances. I can't really think of anything else that's going to help improve, except just keep your nose clean. And if you're making any changes, pick up the phone, give me a call, let us know.
Yeah, awesome. Well, thank you, Gary. I know this has been a good refresher for me. I hope it's been helpful for somebody out there who's considering buying a house this year. If I can help you, let me know. Again, I'm Doug with Weichert Realtors, or Gary, he's with Fairway Mortgage. Thanks, Gary. Appreciate it.
Doug, thank you for having me.